Every fall, usually in September, we have a correction in the market. But September was a pretty good month this year. So we've had a correction here in October. And my belief is that it is a correction prior to the rally that we fully expect to happen after the midterm election.
Hi, I'm Joe Zidle, Investment Strategist with Blackstone, and welcome to our Q4 webinar, No Market is an Island. I'm joined, of course, by Byron Wien, Vice Chairman, Private Wealth Solutions, and an Investment Strategist. Welcome, Byron.
Good to be here, Joe.
Over the course of this webcast, Byron and I will take you through our views for global markets in the fourth quarter, focusing on some of the risks and opportunities from outsized domestic growth to ongoing international uncertainty, and we'll also leave plenty of time for your questions. With that, thank you for joining us. Byron, let's get started. I would ask you to share with everyone why the title, No Market is an Island.
Well, for all the political turmoil in the United States, because of various political considerations, the U.S. market continues to plow ahead almost every day. And compared to markets around the world, we're doing much better than other markets. Japan has hit a new high, but Europe and the emerging markets have been having troubled times, while the U.S. is making a new high. So the question is, who's going to give way first? Is the United States going to go down, or are the other markets around the world going to go up? But we can't have the U.S. standing out alone as the best performing market in the world. It isn't an island. It's part of the global economic universe.
Well, if that's the backdrop, let's get started.
Okay, here are the 10 surprises for 2018, and I've gone over them, and it's a pretty good year for the 10 surprises as they go. But I thought I'd just highlight a few things. I think China played a key role in getting North Korea to agree to cut back on its nuclear effort. Donald Trump went to Singapore. He got Kim Jong-un to agree to trim down his nuclear development program. And he came back to the United States. And people may have criticized him for not getting enough, but nobody in the United States talks about going to war anymore with North Korea. Now, maybe that'll erupt again, but right now, that's not a trouble spot in the world we're worried about. Populism has intensified around the world. Tribalism and anarchy are there. This is particularly true in Europe. The Brexit negotiations are not anywhere. I'm hopeful that progress will be made before the March 29th deadline, but there's no question in my mind that populism is on the march. So I said the dollar would finally come to life because real growth would exceed 3%, and our interest rates are higher than they are almost anywhere else in any developed country. And so I thought that the dollar would be strong. It's not as strong as you see here, but it definitely has been strong for the second half of the year. The U.S. economy is having a better year, plus 3% growth than it had in 2017, and there was nothing to complain about in 2017. That is Donald Trump's triumph, that we have 3% growth and below 4% unemployment. We have some speculation, and the market had a 10% correction in February, but hasn't had a significant correction since then. And I definitely think it will end the year above 3,000 by the time 2019 begins. Number 5, crude oil, West Texas, moves above 80. It's $75 today, and I have 3 months to go. I'm very optimistic that disappointing production from fracking, reduced production from Iran and increased demand is going to drive the price of oil higher. Inflation is becoming a concern. I don't think it's as big a concern as Joe thinks, and he'll have a chance to defend himself during the presentation. But inflation is definitely on people's lips, and I think it's going to continue. Average hourly earnings are not approaching 4%. Average hourly earnings are close to 3%, but they're not 4%. And the consumer price index is 2%, not 3%. So inflation is not as serious as I had feared. Interest rates are rising. I have the 10-year Treasury moving toward 4%, but it's at 3%. 3 is toward 4 compared to where we were a year ago, but it's not 4. So both inflation and interest rates have stayed lower than I originally feared. Both the NAFTA and Iran agreement were going to endure, in my view, at the beginning of the year. Now we have a deal with Canada, so NAFTA in some form is going to exist, but Trump has pulled away from the Iran agreement. And my view, that was not a smart thing to do, but we'll see how it works out. I think that both Canada and the United States, as well as Mexico, think that giving up NAFTA would be a mistake. I think Trump does feel that not being a part of the Trans-Pacific Partnership was not a good idea, because that has enabled China to be the dominant political power in Asia. And with their Belt and Road policy, they're even moving further ahead on that. Number 9, I have the Republicans losing control of both the Senate and the House. I think the odds are very high they'll lose the House. Not so high that they'll lose the Senate, but it's not out of the question. We'll see how that turns out. There's no question that the last sentence in that surprise is right. The midterm elections are turning out to be a referendum on the Trump presidency. And finally, Xi Jinping has broadened his authority at the 19th Party Congress, and he's focusing on China's credit problems. He wanted to slow the economy down. He has slowed the economy down, but then the economy slowed down based on a loss of momentum itself. And real growth is probably dropping toward 5.5%, which has implications for employment in China. So the situation in China is it's slower, it's moving more ahead more slowly than the government would like, and they're going to have to do stimulative things to prop up that growth. And those stimulative things are in the form of infrastructure spending and monetary easing, and they're doing both of those. This is my radical asset allocation. Only one significant change. I've reduced Europe from 10 to 5, but otherwise it's as it was for the beginning of the third quarter. 5% in global multinationals, 10% long only, other US, 5% Europe, 10% of the emerging markets. It's hurt me this year, but I think it's going to reward me in 2019 and maybe throughout the rest of this year. 10% in Japan. That one is working. So that's 40% long only. Then 30% in alternatives, 10% in hedge funds, 10% in private equity, 10% in real estate. Nothing in gold right now. 5% directly in natural resources. And then this is what makes it radical. 15% in non-conventional bonds, mortgages, high yield, leverage loan, mezzanine, emerging market debt, and finally 10% cash to take advantage of any opportunities as they appear. So let's take a look at the island of prosperity. This is a blow your socks off chart. You can look all the way back to 2004. There's never been a case where the United States economic growth is as uncorrelated as it is right now with the rest of the world. And that's something we have to think about, because either we're going to get more correlated or perhaps something unexpected is going to happen. Now, the question is, we've had bear markets in the emerging markets in the past. In 1994, they were down close to 20%, down more than 30% later on. And in both those cases, the U.S. market kept going forward. So this isn't the first island experience we've had, but it's a pretty important one. Joe, why don't you take over here? This is a fascinating chart.
Yeah, so as Byron talks about, the U.S. data continues to be pretty strong, whereas data around the rest of the world has broken down. And what this chart looks at is leading indicators in the Eurozone and the U.K., and both have rolled over. In more recent updates, we've seen PMIs in the Eurozone and Spain and Italy weakening further. Now, this is important because the leading indicators and the PMIs are going to be used as they do correlate pretty strongly to corporate profits. It's also a leading indicator of economic growth, and it's also things that central banks will use in their forecasts. So what this chart indicates is that the hard data in Europe could potentially still get worse. What this chart looks at is U.S. companies, particularly large, mid, small caps, and their exposure to revenues outside the U.S. And if one is really worried about the rest of the world having a cold, then you want to look at small caps, because they are the most inwardly focused companies in the U.S. They tend to have the least amount of foreign revenue. As you can see here, it's only about 20% of the S&P 600 small cap, or about 20% of the Russell 2000, whereas large caps get nearly 40% of their revenue from outside the United States. This chart is one that we featured in this webinar for a long time now, and this is the Ned Davis Research Crowd Sentiment Poll. And in the beginning of the year, in the first couple webcasts, one of our calls, and specifically this was Byron's view that we would have a 10% correction, was really predicated on the data that we were seeing from the Crowd Sentiment Poll. Because at the beginning of the year, there was almost euphoria for equities, and then that quickly corrected. And you can see from the bottom panel here on this chart, sentiment has turned more positive to equities, but we're not yet at a point that is extreme optimism. So overall, this indicates that equities can continue to go higher, but this is a chart that we are watching pretty carefully. Now, this is one of my favorite charts, and in the beginning of the webinar, Byron alluded to us having a disagreement on inflation and interest rates. So I wanted to include this chart as my opportunity to defend myself. And what this looks at is a period in the 1960s compared to today. And the reason why I want to show this is because in the beginning of the year, when taxes were cut, a lot of people said that it was unprecedented to see a tax cut at a point when we were not in recession. But it turns out we have seen that before, and we know what happened. What this chart looks at is unemployment in the 1960s, being the lower blue line, and you can see it started off around 7%. But by the mid-1960s, unemployment had fallen all the way to 3.5%. And yet prices, which is the bottom line, remained stable. So the government said, okay, prices are stable, let's go ahead and cut taxes. Taxes were cut, prices still remained stable. And then they said, okay, let's go ahead and increase deficit spending, the old guns and butter program from the late 1960s. The federal government deficit increased by 55% in 4 years. And then all of a sudden, in the late 1960s, inflation started to leg up. So here we are in 2018, and the unemployment rate has fallen to near similar levels, and prices, as you can see, have remained relatively stable. I think the big risk here is that tight labor markets are going to bring a bout of inflation that people are not prepared for. There is inflation today. It's widespread, but it's not yet strong. My concern is that inflationary pressures are going to accelerate. Now, to focus on the U.S. economy for a few minutes, the good news here is in this chart. And this is one that we've shown before, but I think it's such a powerful chart because what it really illustrates is the double-edged sword that we have today, where we exchanged low growth for longevity. And basically what the chart shows is from the mid-1960s until 2008, the economy reliably grew around 3% per annum, 3.1%. After the great financial crisis, growth dipped down to 2%, and it's averaged that for basically the last decade, up until the beginning of this year when growth started to accelerate. And that produced a near $3 trillion gap between what had been the average rate of growth in the United States and what we've experienced over the last decade. Now, the good news is, had we rebounded quickly, this cycle would have ended a long time ago. But because we did have this very slow recovery, we are now one of the longest economic cycles we've had in history. And as long as we avoid a recession within June of next year, or by June of next year, this will be the longest recovery that we've seen in history. And I think we'll easily do that. I think the next recession is still years away. Now, what this chart illustrates here is one of the reasons why growth had broken down. And if you think about GDP growth over the long term, it's really just the combination of productivity growth and population growth. And that's the second and third bars in this chart. And basically what the chart shows is from the mid-1950s through today, productivity growth averaged about 1% a year. Population growth averaged a little over 1%. You add them together, you got GDP growth. But that productivity growth was cut nearly in half at the same time that population growth slowed. That resulted in weaker than expected GDP growth. But the good news for us is that productivity is starting to increase. We're finally starting to see these numbers move higher. And I think that means from now through the end of the cycle, we're going to see some of the strongest growth that we had seen at any point since this recovery began. Now, just to turn our focus to the consumer for a minute, this is the savings rate. And some of you might have followed how the savings rate was just revised higher. Basically, every 5 years, the government does a look back over the data and makes any revisions or changes. And they took up the savings rate pretty dramatically. So what the chart shows is that the U.S. consumer still has room to spend. The consumer is by no means tapped. This chart is also an additional bullish data point for the consumer. It shows average hourly earnings. As Byron referenced, average hourly earnings have moved higher, but we're nowhere near a danger zone, which is about 4%. And that's something I'll address in a minute. But what we are seeing is that you can't have really tight labor markets without higher wages. So with unemployment below 4%, we're starting to see wage growth move higher. Internally, when you look at Blackstone data, if you look at the portfolio companies that we own through our private equity and TAC ops divisions, what we find is about 60% of the CEOs who responded to our surveys are having to take up their earnings between 3 and 5% this year. So the internal company data that we have access to suggests that some of the government data might actually be lagging on wages. Now, this is looking at corporate profits. As we know, we've been in a really strong earnings environment. Corporate profits troughed in the first quarter of 2016, and this year we're going to see profits growth of around 20% per annum. The good news here is that we've never seen a recession when corporate profits are up. Now, profits at some point will roll over, but we're going to expect positive growth through the remainder of 2018, and we think in 2019 corporate profits growth rate will slow, but it's still going to be positive. Now, this next chart looks at CapEx. And this is something that we think is going to be a surprise to investors for the remainder of 2018, 2019, and beyond. And that is, if you think about what companies have done since this recovery began, they've done everything but invest for growth. They've done share buybacks, M&A, increased dividends. But what they haven't done is actually put money into the ground through plant, property, and equipment. And what this chart highlights is both CapEx forecasts for manufacturing and non-manufacturing. And it's using two snapshots in time, December 2017 and April, May of 2018. And what changed here was the tax cut. Now, we don't think the tax package is enough of a reason for companies to do CapEx, but when taken with accelerating growth, bottlenecks, and labor shortages, companies have a lot of incentive in order to start expanding for future demand. And this sector drills into CapEx a little bit more specifically by looking at the energy sector. And what you can see is that the energy sector CapEx is running significantly below its historic average rate. That's the blue line, and in the background is world oil demand. And basically what it shows is that CapEx would follow demand or follow prices. And now we've got WTI back at $75 a barrel, as Byron referenced, yet companies are still being very disciplined with respect to their spending plans. Now, we think at some point that will pick up, And I think investors who are willing to go into the energy space today are going to be rewarded for committing that capital. So Byron, I might turn things back over to you to take us through growth and small businesses.
The American economy is dependent on small business, and this shows small business sales growth, or at least the small business people are expecting higher sales growth. And when they do, they're usually right. And the percent change in nominal GDP follows. So this is another reason to be optimistic about the economy in 2009. The leading indicators are key. When the leading indicators roll over, watch out. There can be a long lag, as there was in the 1980s. But if you look at it, every time the leading indicators have shown a top, a recession is followed. But you usually have plenty of warning, and the leading indicators haven't topped yet, and that's why we think that this business cycle is going to continue into 2021.
Yeah, and Byron, if I can interrupt here, it's worth pointing out that consensus believes that the yield curve is going to invert in sometime in 2019, and that their next recession will follow in 2020. And what you hear from Byron and me is that we think the next recession is going to be sometime after that, 2021 at the earliest. And this is just one of many data points that indicate we still have a long runway.
And let me ad lib here for a moment and say something I said in the morning meeting today. We can't afford another recession. If we get into a recession, we don't have the tools to get out of it. There are two principal policy-making tools that we could use. Tool number one, Federal Reserve policy. Interest rates are already low. Lowering them further would probably not stimulate much capital spending, especially considering that we may be doing less tightening next year than we did this year. The second thing is fiscal spending. The budget deficit in the United States is already $1 trillion. We don't want it to get any bigger than that. So it isn't likely that we're going to engage in a lot of capital spending projects at the federal level in order to get the economy humming. So without being able to have fiscal spending or monetary easing, my view is we're going to try to do whatever we can in terms of policy making to prevent the next recession from occurring for as long as possible. Average hourly earnings are increasing, but they're not anywhere near the trouble spot yet, which, as you can see from the ochre line, is 4%. Well, we're nowhere near that. And as a result, there still is a positive yield curve. The 10-year to 2-year spread is still comfortably above zero. Now, this is an important chart. What this shows is the utility of investment. In the 1950s, for every dollar we invested, and that's shown in the change in debt, we got 73 cents in GDP growth. We got a lot of bang for the buck in our investments in the 1950s. It carried through in the 1960s, down to 66 cents, and even in the 1970s, 59 cents. But then in the 1980s, that changed, and it dropped almost 50% to 34 cents, and then 31 cents. And then finally, in the first decade of the new millennium, 17 cents. Now think about it. Would you put a dollar into the ground or in some form of investment if you were only going to get a 17-cent return? I don't know whether you would. Anyway, now we're back up to 37 cents, and I think that is satisfactory. This is on GDP. A lot of people are talking about debt. This is public and private debt as a percentage of GDP. Right now it's 350%, which is a big number, but it's not as bad as it was in 2007. That's the most I can say about it. And this shows that one of the reasons I was very positive on the dollar, because our 10-year Treasury yields are 3%, and most other places in the country, they're 2% or less. And so I can't understand why every foreign sovereign wealth fund isn't putting their free cash into the U.S. Now, who buys our Treasury securities? We know from my comments earlier that we're going to be issuing more of them. There are three big buyers. The Federal Reserve is a big buyer, China is a big buyer, and Japan is a big buyer. And that's why we have to tread carefully on tariff policy, because if China and Japan are hostile to the United States, one of the ways they have to fight back is by not buying our treasuries. And there's some evidence of that. They've bought many fewer treasuries in the first half of 2018 than they did in the first half of 2017. So, you want to take these, Joe?
Sure. So what this chart looks at is our trade wars in numbers. And what it shows so far is that the proposed tariffs plus the actual tariffs are really just a shadow of the combination of tax cuts, both at the corporate and individual level, but also the repatriation. And I think there is a major shortcoming in looking at the tariffs simply this way, and that is our supply chains are so interwoven and so interconnected that, simply just adding up the amount of tariffs and saying, oh, what's the big deal? It's 10% of $200 billion plus another $37 billion, and then saying, well, we're a $17 trillion economy, so what does it really matter? I think what that misses is that our supply chains are such that the law of unintended consequences has to be considered, right? This is more like chess, where in the opening move of a chess match, the first combination, there are 400 options. The second turn of a chess match has over 70,000 combinations. And by your third turn, you're at over 9 million choices. So in other words, this is chess. It is not checkers. And I think what we have to consider is that the tariffs that are in place today, plus the ones that are still coming down the pike, could be more inflationary than people are willing to consider. We're seeing that through input prices. Today, you don't hear a lot of CEOs talking about the trade war, but you do hear many, many more CEOs talking about higher input prices. They're one and the same. Now, the bottom chart looks at the U.S. versus the Shanghai Composite. And what it sort of argues is that the U.S. is inherently handling the trade war better than China is. And I think going into the trade negotiations at the beginning of this year, there was the notion that the U.S. was inherently in a stronger position because our economy had momentum. As Byron talked about China, he mentioned they were already slowing their economy to deal with non-performing loans, and then they had the unexpected hit of the trade war. Now, it's our view that China's going to do everything that they can to try to de-escalate the rhetoric and potentially slow walk the negotiations because they want to avoid the direct confrontation. And you can see here it's already weighed on Chinese equities that have fully corrected, whereas the U.S. has maintained its position of strength. But the warning here is watch out, because I think the impact of the trade war could be greater than simply just the sum of the numbers on the left and right sides of the top chart. Now, this looks at our major trading partners. And you can see China, where we have a massive trade deficit. But Mexico and Canada, when you consider services, there is not even much of a deficit to speak of. We now have NAFTA, or at least a new form of NAFTA, the USMCA, behind us. So it at least takes a couple conflicts and moves them out of the spotlight. But China is still one that we are watching carefully. Now, this chart looks at asset class returns both before and after midterm elections. And what you can see is that after midterm elections, virtually all asset classes perform pretty well, but it's your higher beta or cyclicals that really tend to outperform, right? So after a midterm election, you see high yield outperforms investment grade, you see that cyclicals outperform defensives. But generally speaking, after midterm election, it's pretty good for risk assets in general. Byron, back over to you.
Okay, this is my dividend discount model. You've seen it before. We've been using 170 for S&P earnings for 2019. Now that we're in the fourth quarter, we can think a little more deeply about that. 174 seems to be a number cropping up. And if you go to the 3% yield on the 10-year Treasury, this model is based on the fact that if you know where interest rates are and where the S&P earnings are, I can tell you the point at which stocks and bonds are fairly valued. Well, that number is 29.13, which is where the market closed on Friday. Now it's having a big day today, and the market, when it opens each day, it doesn't know I have this page in my handout, and so it goes where it seems to feel most comfortable, and where it seems most comfortable right now is higher than 29.13. But 29.13 is the fair value, the equilibrium point where stocks and bonds are equally attractive at current earnings estimates for next year and at current interest rates. So the market can continue to make progress, but if it goes too far ahead of this, it's vulnerable to a correction. But it is not overvalued on the basis of a model relating interest rates to S&P earnings. In terms of next year, we've had delightful earnings this year, up 23%. They're going to be half that next year, and we'll see how the market responds to it. But this is an earnings-driven market, and earnings are still moving ahead 10%, and they'll move again close to 9% in 2020. So whatever problems we have, geopolitically, politically, or economically, have not shown up in earnings yet. This shows that not all gridlock is created equal. If you have a Republican Congress and a Republican president, as you had in 2017, the market can do very well. It can do very well under Democrats too, as long as you have a Republican House. It can even do well if you have a Democratic president and a Republican Congress. And it doesn't do too badly if you have a Republican Senate, a Democratic House, and a Republican president. And when you have the Democrats in control, it still does pretty well. So it almost always does pretty well, regardless of the political environment. And even if you have a Democratic Congress and a Republican president, it still is positive, but not satisfactorily so. This shows that there's not been a case where, since 1946, where we've had a down market after in the 12-month period after the midterms. Now, sometimes it hasn't been up very much, but it's always been positive. So let's hope that holds this year. And in terms of tax rates, I think this one is really important because it shows, if you look at the blue line, that's the OECD, and it shows that as a result of cutting taxes, we're down to pretty much parity with European countries. And what this shows is that the stock market follows earnings. And so as long as the earnings hold up, that's going to continue. Joe, you want to comment on this one?
Sure. So we titled this slide, "The Market Goes Up Until the Fed Stops." And the reason to focus on this is because now the Fed has hiked 8 times since it began this hike cycle, and it's probably going to hike again before the end of the year. Now, that doesn't necessarily cause trouble for stocks, as we can see in this chart and the table below. What it does tell you, however, is you want to be careful once the Fed stops hiking, because what happens at the end of a hike cycle, you tend to get that inverted yield curve. The inverted yield curve is the most accurate predictor of business and economic cycles. It inverts. Once it does, you have 12 to 18 months before your next recession. And for investors in public equities, once the Fed stops hiking, the data tells you that the market starts to price in the next downturn. So you might have 12 to 18 months before your next recession, but from the time the Fed stops hiking, you've got less time until the market peaks. We're not there yet.
Yeah, this year is a good laboratory. The Fed has tightened 3 times, probably will tighten 4, and the market's gone up almost all year except for February.
Yep, and this chart looks at investor positioning. And I think this is a really important chart here because if you think about the things that end bull markets, we talked about one already, which is an inverted yield curve. Another thing that's going to end a bull market is euphoria, and that's when investors are all in, right? That would be like 1999 or 2000 with the NASDAQ. Or for fixed income investors, that would be like June of 2016 when the 10-year Treasury yield hit 1.35% and you saw massive inflows into fixed income. Well, for this bull market, this could very easily go down as one of the most unloved bull markets in history. And what the table shows is, even though you've had massive inflows into U.S. equity ETFs, it hasn't been enough to compensate for the outflows out of U.S. equity mutual funds. And as a result, you have investors who have been net sellers of this equity bull market since it began in 2009. I think it's important because it is not an over-owned market. Turning to the next slide, looking at global growth rates, and what you can see is India and China are 2 of the fastest growing economies in the world. We know that the China growth rate is slowing, but it still remains among one of the fastest of major markets developed or emerging out there. In general, emerging market economies continue to expand. And the point on this chart is that, growth around the world is still relatively good. Now, we understand that LEIs, leading indicators, and PMIs have rolled over in Europe, as we had mentioned earlier in the webinar. But generally speaking, there's still pretty good global growth rates around the world. I think emerging markets are probably going to be one of the most interesting opportunities going forward because while their economic growth is slowed, their equities have discounted, I think, more than enough damage already. And this chart here shows PE ratios around the world. You can see that outside the US, you can still get cheaper valuations. And if you look all the way on the right-hand side of this table, you see emerging markets trading at about 12.8 times trailing 12-month earnings. Well, if you look at emerging markets on a forward valuation basis using 2019 estimates, what you see is that emerging markets are really only trading around 10.6 times their forward earnings. That is cheap by EM standards. Historically, when emerging markets have traded at a valuation below 11 times, performance has really been pretty good. So we think there's an opportunity in emerging markets. In our most recent essay, we alluded to that, discussing how emerging markets are probably very close to a buying opportunity. Here's a story, I think in Japan, that's a pretty positive one, and that is, corporate profits, and it shows how profits are really tied to the level or the direction of the yen. And Japan is massively dependent on its foreign revenues, on its exports, and historically, when the yen is weakening, their profits are up. Well, we know the dollar is strengthening against the yen. That's pretty positive for the Japanese profit story, and I think that explains a lot of the strength that we've seen in Japanese equity markets recently. And I think that can continue. Lastly, looking at China, their PMIs are remaining above 50. As we talked about, China's growth is slowing. It's a combination of policy-led slowing, which was really the government trying to take care of its non-performing loans. Another part of that slowdown was due to the tariffs trade war that has been brewing all throughout 2018. But as long as their PMIs remain above 50, that's still expansionary territory, and I think China can end up weathering that storm. Now, Byron, I'll turn it over to you for some longer-term considerations.
Okay, just a couple more slides left. As you know, we've been thinking and talking about inequality, and long-term inequality is going to be a problem. Don't expect me to come up with the solutions to it, but I do want to illustrate the dimensions of the problem and where it exists. It's a problem of developing countries. It began seriously in 1980 with globalization and technology. And what this shows is the Gini coefficient. That may be arcane to some of you, but what it means is this. If all of the people had the same income, the country would have a Gini coefficient of 1. And if one person had all the money, the country would have a Gini coefficient of 100. So you want to be as close to 1 as possible. What country is as close to 100? The US with 35, followed by the UK about 32, Italy at 31, France, Japan, and Australia hovering around 30. So the developed countries of the world have a high Gini coefficient. The countries where there is more equality are in Scandinavia, Sweden, Finland, Denmark, and Norway. And so those countries still have a problem, but I don't think it's a problem that's causing political unrest. The companies at the right-hand end of this regression line are the countries where inequality is likely to be a political problem. And finally, this is a pet peeve of mine. I'm a big believer in liberal education. I think the most imaginative people get it. I think that investing or focusing on computer science may get you your first job, but I'm not convinced that the most creative people will come out of those fields of concentration. I believe that English, history, languages, and literature are important. And now that people are thinking about their paychecks, that more and more of them are majoring in computer sciences. And I think that may augur well for a lot of companies being formed in Silicon Valley, but I'm not sure it augurs well for continued innovation in the United States. We'll see how this works out, but I just wanted to highlight it. Joe, why don't you take the questions and answers?
Yeah, well, thank you, Byron. And at this point, we want to turn to Q&A, and there are some questions that were submitted in advance, so we'll go through a couple of these. And Byron, both you and I can sort of ad-lib here on the answers. But taking the first one, taking a step back and reflecting on the recent positive news on trade negotiations with Canada and Mexico, has the Trump administration's hardline stance on trade been a positive in some ways? And secondly, how do you predict the trade dispute will be resolved?
Well, we've resolved it with Canada and Mexico. I think we will resolve it with Europe. I think China represents a serious problem. I think we have some serious grievances with China. But I'm optimistic that we will resolve them, because China sells $530 billion worth of goods to us. We're a very important market to them, and it is in their best interest as well as ours to work that out. But it's going to take some time to work it out. And we're not exactly pursuing it in the right way. To try to convince China to pull back on its Belt and Road policy, to pull back on its Made in China 2025, and to slow down its scientific development. Next year, China is going to be spending more money on research and development than we are. And to ask China to slow that down when they're determined to be the technological leader of the world sometime in the mid-2020s, I think that's a mistake. China will never agree to that. But I think there's enough common ground for the U.S. and China to work out a trade policy. I think it'll just take time.
And just to put it in perspective, the reason why we don't think that China would ever agree to the demands of the administration with respect to science and technology and really their innovative drive here is because China's got a bigger problem that they're trying to solve for, and that is how to take the 400 million people that they dropped into their middle income and raise them to high income, right? So if you think about it, China lifted an entire population or hundreds of millions of people out of poverty and dropped them into middle income simply by being a low-cost producer. But you can't go from middle to high income through low-cost manufacturing. You need to do that through innovation, through technology, and research and development. And that's what they're trying to solve for. Now, in doing so, it also puts them squarely at odds with the U.S. So that's why we think that this trade dispute is going to end up going on for a lot longer than most people expect. Now, turning to the next question, it's somewhat related to politics, Byron, and that is markets seem nearly impervious to political turmoil. Is there any election outcome in November that you think would spook investors?
I think if the Democrats take the Senate as well as the House, I think that will cause a temporary setback in the market, because I think it will create turmoil in Washington. It will certainly put additional Supreme Court justice appointments in jeopardy, and the Democrats may try impeachment, which I think would be a waste of time, but they may try to reestablish the Affordable Care Act and perhaps even the tax cut. So if the Democrats take the House and the Senate, I think there's going to be a lot of fighting in Washington. And the fighting is going to be on issues that the investors like. And so therefore the reaction might be negative. But as I said during the course of the presentation, it's earnings that are going to drive the market. And if what the Republicans do, or what against the Democrats, or what the Democrats are able to get through, doesn't hurt earnings, the markets will be okay. But as we projected, earnings growth next year is going to be half what it is this year, and that's going to determine the course of the market.
Yeah, earnings, and the second variable to think about is interest rates, because when it comes down to valuation, we're not necessarily valuing companies according to midterm elections, we're valuing them according to how much they earn and what the interest rate environment is like. So not only do we see a slowdown in earnings in 2019, but we also have the prospects of higher rates because we know the Fed is going to be hiking, and the 10-year Treasury yield, today is sitting just above 3%, and it does threaten to break out. So for those reasons, it could be a more challenging year for equities in 2019. Now, interestingly, when we showed that slide on gridlock, what it indicated was a Republican president and a Democratic House and Senate produced an average return of 4.9%. It's positive, but it's actually below the long-run historic average of the S&P 500, which, depending on what date range you choose, usually averages about 8.6 to almost 9% per annum. So there's no outcome in terms of looking at combinations of the presidency and Congress that's negative for equities, but there are some that are certainly below historical averages, and a Republican president and a Democratic Congress is one of those, so that's worth watching. We have a couple more questions here that were submitted, Byron. The next one is on Brexit. And it says, details around the negotiations remain uncertain. Do we have any confidence level at all in a soft Brexit? But maybe I could extend the question and say, the differences between a soft Brexit, a hard Brexit, or no Brexit. Why don't you weigh in on that entire spectrum, if you don't mind?
I think that before March 29th, there will be a deal. And I think it'll be, the deal will restrict travel and immigration to the UK, but it will permit reasonable trade. It will protect the borders of Northern Ireland, which will still be a member of the EU. So my view is that there will be a deal that will permit Europe and the UK to trade with each other on some basis not extraordinarily dissimilar to what existed before. So I guess that's a soft Brexit. A hard Brexit would be deleterious to both Europe and the UK, and maybe something in between will be the compromise.
Well, last question, and I feel like we talk about this each quarter. In the near term, what, if anything, do you think creates a risk for a recession?
Well, the price of oil is going up. High prices for oil have caused recessions in the past. I think Iran is a wild card, and we're being pretty tough on sanctions with Iran. I think Syria is a trouble, so the whole Middle East situation is difficult. If the Straits of Hormuz were closed, I think that would certainly create economic turmoil in the world. So I think a geopolitical incident could do it. I think oil could do it. And I think you're being right, and inflation erupts and interest rates follow it. And we see the yield curve invert and the 10-year Treasury go to 4% or above. That could be a problem.
Yeah, that could be a problem for corporate debt. When you think about traditional fixed income, the number of companies in major markets today whose earnings before interest and taxes is not enough to cover their debt service is about 14%. And so higher rates would mean a higher implied cost of debt service. I think for a lot of companies that could be problematic. We're not seeing that today. And in fact, as the growth is accelerated, the number of companies that can't cover their debt has not been a problem. But if we do see their cost of financing going up through things like higher rates, then that is a risk and something that we would be watching. So that is it for.
Let me just pile on here for a second. One thing we're going to be talking about next year is the whole situation with unfunded liabilities, both at the federal government for Social Security and at state and local levels. There's a tremendous amount of debt out there. So with all of that debt and some of it coming due, and with the diminishing of liquidity, I think that could seep into investor thinking and create a negative mood. We're going to monitor that very carefully, and we'll be reporting to you on it.
Thank you, Byron. And thanks again for everyone who tuned in with us today. In closing, I'd like to remind everyone that our next webinar will be January 10th, 2019. And lastly, if there were questions we didn't get to, or if there are any other concerns or feedback, please let us know at Byron Wien's commentary at blackstone.com. Thank you.